All right, get out your Chapter 14 lecture notes and follow along. We're just going to introduce the ideas behind capital budgeting and also look at the time value of money, and then we'll cover the capital budgeting techniques during class. All right, so what is capital budgeting? It's the process of making decisions regarding long-term investments. Now notice that this is long-term. Everything we've done in this course up to this point has really focused on the short term. All right, so we have to manage the supply and demand of capital. Most companies are going to have more opportunities to make investments than they're actually going to be able to make because of limited capital. So what we want to do is make sure that our investments have an acceptable return. We're going to be looking at investing in productive assets like buildings and productive equipment in this class. All right, now again, they do provide a return over a long period of time, so the best techniques do consider the time value of money. Now we're going to look at 4 different techniques during class, and only 2 of these actually do consider the time value of money, but the best ones are the ones that do. We will have problems that are real 2 major types. Independent projects where you're deciding, should we invest in this equipment to begin a new product line or to increase production? And then also mutually exclusive projects where you'll be given 2 pieces of equipment that you could invest in and you have to choose one. So there you will be deciding between 2 or more alternatives, and this is where we'll learn to use these techniques for ranking the various projects. Another thing to think about as we move along is that these do focus on incremental cash flows, cash inflows and outflows. So much of what you've done in your accounting courses up to this point have really focused on profit or income. We will be focusing on, most of the techniques will be focusing on cash flows. So here's the cash flows you should be looking for in the various problems that you see. Cash outflows, you'll have to buy the equipment. That will be your initial investment. You may have to increase the working capital. I think the last example in the lecture notes will see this come into play. But what that is saying is that when you say buy productive equipment to increase production, you may have to tie up some assets so that you're able to buy more materials, pay more workers. And so when you earmark those assets, that cash or inventory for these purposes, you're going to treat that as an outflow. Any other additional expenses such as repairs and maintenance or operating costs like utilities that will increase as a result of making the investment. Now, typical cash inflows, there's incremental revenues and reduction in costs. Now, reduction of costs can be called operating savings. That is saying, if we buy the equipment, we will reduce our labor costs by X amount. Now, notice the incremental revenues and or a reduction in cost will occur, or there's really no reason to make the investment. So you will see one or both of these as the reason they're considering the investment. Then you may also see salvage value. They're talking about when you buy an asset and you plan to sell it at the end of the asset's life. That's the salvage value, and that will be an inflow of cash. So if you buy equipment for $100,000, that's an outflow. If you sell it in 5 years for $10,000, that's an inflow of cash. When you release the working capital, even if it's at the end of the project's life, it will also be treated as an inflow of cash. One other thing to observe, if you're given income instead of these specific cash flows, you can convert income to cash flow by adding depreciation expense back. So you've seen this before when you learn to prepare statement of cash flows, but we'll walk our way through it via some examples. All right, before we can begin our coverage of the capital budgeting techniques that you'll need to understand, we are going to look at the time value of money. And you've seen this before, probably in your earlier accounting class or maybe a calculus class. And the idea is that a dollar received today is worth more than a dollar to be received sometime in the future. The further away in time the cash flow occurs, the less it's worth. This is due to interest and inflation. You can invest the money now if you have it now and earn interest. And usually we see periods of inflation, meaning you can buy more now than you can in 5 years with the same amount of money. All right, again, the further away in the future the cash flow occurs, the less it's worth. And if you hear someone say we're going to discount the cash flows, they're referring to the idea of bringing all future cash flows back to what they're worth today. All right, we'll have 2 exhibits that you will be given on the final exam, and you can find these in your book. And I've attached those to the file with the lecture notes, so your last pages in your lecture notes show the tables that we're going to use. You can find the present value of any future cash flow by taking that future value or future cash flow and you multiply by the present value interest factor. I'll abbreviate that PVIF. You will have to specify the interest rate and the number of time periods. Now if you turn to the end of your lecture notes, the first table you see, present value interest factor of a dollar. This is when a cash flow occurs one time in the future. And along the top you see interest rates. For our purposes, these will always be annual interest rates. So these in number of years, this will always be years. Now I have zoomed in on just part of it so you can see these factors a little bit better. And we're going to use these to work an example. Your long-lost uncle left you a substantial inheritance. With the money, you plan to travel and continue your education, but you want to put enough away in the bank today, earning 6% per year, so that in 5 years, you will have the $200,000 necessary to buy your first house. How much money needs to be deposited today? So we're trying to find the present value of $200,000 5 years from now if we can earn 6%. So to get the present value, we'll take the future value, $200,000, and we'll multiply by the present value interest factor. So if you look at your table, remember that we're told we can earn 6% on our money, that's per year, and we're going to invest it for 5 years. So our factor is 0.74726. So the present value of $200,000 5 years from now, if you can earn 6% annually on your money, the present value is $149,452. Now we're going to take these concepts and apply them to capital budgeting situations, but you do need to understand just those basic principles behind finding the present value of a cash flow that will occur in the future. We also have present value of an annuity table that you'll be provided on your final exam. And remember that an annuity is a series of equal payments over equal time periods or intervals. They have to be the same amount every year for X number of years. You can find the present value of an annuity by taking the annuity amount. If you're getting $1,000 a year for 5 years, you'll take that $1,000 times the present value interest factor for an annuity. Now this is what the annuity table looks like. Again, it's kind of hard to see. You've got it attached at the back of your lecture notes, but you will have annual interest rates along the top and time periods here on the side. Notice that these factors, after you get beyond year 1, these factors are all greater than 1. And what they do is build in the interest that you earn for each payment and the interest on the interest for each year that you have the annuity. Again, I zoomed in on just a part of the table. This is years 11 through 21 and interest rates 6% through 11%. Just to let you see those numbers a little bit closer. And this is the part of the table we're going to look at with our example. All right, now you've won a $200,000 sweepstakes. You can have the $200,000 today or payments of $10,000 per year for 20 years. So if you do the math, either way you're getting $200,000. You can earn 10% on your money, and you want to calculate the present value of both options. So this shows you why present value is helpful. It is difficult to compare these because they're at two different points in time. One occurs right now, $200,000 today. One occurs over 20 years. So we will find the present value of both options. The present value of the $200,000 today is $200,000. There is no time for interest or inflation to take effect. Now the annuity, the present value of the annuity, recall that you're going to get $10,000 per year every year for 20 years. So the annuity amount is $10,000, and we can earn 10% on our money. It's a 20-year annuity. And if you look at your table, it shows it a little bit better than the table I presented. Look at your table at the back of your lecture notes. The factor is 8.51356. So the present value of the annuity is $85,136. Now you can compare these two options. One today is worth $200,000. The other is worth $85,136. And the reason is, of course, this company is using your money to earn interest, and you're losing interest over 20 years and the compounding of interest, that is interest on your interest for that time period. All right, so this demonstrates how to find the present value of future cash flows, and it also demonstrates what you do when you're trying to make comparisons of two things that are a different time period. You can bring them back to the present. Now what we're going to start with next time is just going over the 4 techniques that you are going to need to know.